Hello traders and welcome to a trading lesson on price structure. Price structure is useful for technical traders. By definition, technical traders use usually price information, but information provided by the market to make decisions about what may happen in the future. I'm a price action trader. You can also be a support and resistance trader, an order flow trader. Market structure still matters. It's kind of the backbone or the basis of most technical trading. So there's two states of price movement. The first state of price movement is within a range. Ranges are prices that move sideways and are not directional. So this is an example here of a range. We don't have, it's not very large or long, but we're going to use it as an example anyway. There are a dozen bars here, let's say, and they're mostly overlapping and they're mostly moving sideways. You do have a couple of false breakouts. There's a false breakout here. There's a false breakout here. And there's one to the upside here as well. And 80% of the time, a range, wants to continue to trade within that range. So 80% of breakouts will fail. 20% of breakouts will succeed. For newer traders especially, it's very difficult to make money trading in trends. Directional probability is low. The middle of a range acts as a magnet, and you basically need to fade moves. So good trades within this range would have been fading this breakout, that is buying this breakout to the downside, shorting this breakout to the upside, and buying this breakout to the downside. The second state of price movement is a trend. And a trend is when price is moving from one place to another place. So it is directional. This is an example of a trend. This price puts in a high at about 21,373, and it moves more or less without much pause all the way down to 21,167. So that is a very big, very strong trend. And it moves in a couple legs. You can see here, this is just visual leg 1. This is visual leg 2. You could call that ending here or ending here. And this is visual leg 3. And we get a reversal at the bottom of leg 3. One way to help learn to identify trends is to mark something called pivots. A pivot is on the high side where a bar makes a high that is higher than the following high and higher than the prior high. So this is a primary or first order pivot. This is also a pivot here. This high is higher than the prior high and higher than the following high. This high is higher than the candle with the bar before and the bar after, and so on. This is one, this is one, this is one. And then on the downside, here they are as well. These candles look very close, but I think this one is actually lower. This is a low that is below the low of the prior low and below the low of the following low. This is also very similar, but this is the lower of the two, and it's lower than the following candle, and there's a pivot here, and a pivot here, and a pivot here. If you connect these primary pivots with just a simple trend line tool on your charting platform, you can see that they do a very good job of visualizing trend. There are two pivot points here side by side without a lower pivot in between, so we just choose the higher of those two. If they were on the downside, as in this pivot and this pivot, we would choose the lower of the two, which is that one there. So this gives you a really great idea of price movement. If we then go and take this concept one step further and we look for pivots of pivots, it is going to take out some of the noise and give us a little bit better directionality. So this pivot here, the pivot before is lower and the pivot following is lower. Therefore, it is a pivot of a pivot. It's a second order pivot or a secondary pivot. So I marked it with 2 arrows. This is also a secondary pivot. You can see there's a pivot here and there's a pivot up there, let's say. So this is a second order pivot. This is a second order pivot. This is a second order pivot. If we then go and connect these second order pivots, they take out some of the noise and they more clearly mark this price movement, this price structure, than primary pivots, just primary pivots do. So this is only then in 3 moves: down, pull back, second leg down, and then it reverses to the upside. So pivots are one way that you can, they're not terribly practical in real time, but in review, marking up charts, reviewing your trades, they're a great way to learn about market structure and trend direction and complex or high time frame pullbacks and continuation, that type of thing. So I definitely recommend if you're not familiar, if you haven't done work with pivots, then spend some time doing that. Mark up 50 charts with pivots. There's your learning challenge. The other thing that we can say, or another way to classify, quantify trending behavior, is when your primary pivot highs and lows make lower lows and lower highs, you're in a downtrend. So this pivot high is higher than this pivot high, so this is a lower high, and this is a lower high, and this is a lower high, so we're in a downtrend. We also have lower lows, lower high, lower low, lower high, lower low. You have to ignore some of this. This would be noise here, this primary pivot, because the pivot following, that pivot high following, is higher, not lower. But if you identify this as a two-legged pullback, which is correct, then you can identify this secondary pivot as lower to the last secondary pivot, and therefore still in a downtrend. And an uptrend is characterized by higher highs and higher lows. So this pivot low, followed by this higher low, higher low, higher low, higher low, higher high, higher high, higher high, higher high, higher high, and so on. And that is the basics of trending behavior using pivots and swings, and ranging behavior, which you don't necessarily have higher highs and higher lows, and you don't necessarily have trending pivots either. So quickly, we'll do one more thing here, and we will look at trend lines and trend channels. So if ranges can be characterized, quantified using horizontal lines, then trends can be characterized, quantified using sloping lines. And it depends on how detailed you want to get, but some trend lines can be quite short and can be quite steep, such as these three trend lines here. And then these trend legs are broken as soon as a bar breaks above this trend line. So this bullish white bar to the upside is the end of this bearish trend because it breaks the trend line. You have to use a little bit of artistic license here. There's a little break there on the second bar. But this trend goes, you could almost say, all the way down here. And then it's broken either by this little doji bar here or this outside reversal bar here. And then the same thing on this third bear leg to the downside. It gets broken either by this little doji bar or this bearish breakout bar to the downside as well. So there's two ways to break a trend line. One is sideways and one is against. These are more or less all sideways breaks of a trend line. So the trend line gets broken here, but this bar is sideways from that bar, and the next bar is sideways from the second bar as well, so this is a sideways break. Then we get a nice, steep, sharp trend to the downside, and we get more or less sideways breakout, 1, 2, 3, 4, 5, 6 bars sideways. These two bars do break above kind of the high of these, so this is like a failed breakout, a failed reversal to the upside, or a failed breakout to the upside, if you want to look at it that way. And then this trend line, if we just fudge this a little bit and we drag this trend line down like that, this is a break of a trend line that is momentum against. So this bar is a very strong counter trend close, and it's followed by follow through as well. So these two bars here, this bar and this bar, they pull back to about 50% of this trend leg. If you want to measure this trend leg from top to bottom like that, this strong breakout or pullback is about a 50% pullback, a 50% retracement of this trend to the downside. So two ways to break a trend line. These are very this is a 15-second chart in the micro NASDAQ futures. These are very short-term, tight trend lines. The other way to draw a trend line is to draw it across multiple legs of a trend. So this, let me just try this again. So this would be an example of a trend line that encompasses two legs of a trend. Something like that. We have a touch on top, we have a touch on the bottom, or a touch in the middle here on this pullback, and then we get a break of the trend line in this sideways pullback. You could potentially draw this trend line across the top of this bigger pullback, second pullback, beginning of the third leg, if you wanted to. When you go to create a trend channel line, so in a downtrend, a trend line is across the top of the price and a channel line is across the bottom of the price. And typically they're parallel. They don't have to be, but it's a great place to start if you're not familiar. And in an uptrend, a trend line is across the bottom of price and a trend channel line is across the top of price. Something like that. And this actually contains price quite nicely. This doesn't really, this channel does not really contain price very nicely. It would be much better if we had a trend line that just encompassed the first two legs, and then we create a channel from there. That's better. It's not perfect, but it's better. If we mark it with if we drag this channel line so there's a breakout here in the middle, it does quite a good job of containing that price. And then if we just draw another channel here on this bottom final leg, that also contains price quite nicely. So trend lines and trend channel lines are also a good way to mark, quantify trend structure. One last thing here we're going to talk about with trend structure is reversals. So we have two states. We have ranges and we have trends. And then there are three transition periods in markets. That is a range turning into a trend. So that is here, let's call it on this big bar at the open, which is also known as a breakout. So that's a change in character from ranging behavior to trending behavior. And then we have trends becoming ranges. So let's just call this a little range right here. So this trend becomes a range here. And that's like a consolidation. In this case, it's a pullback that then breaks out in the original trend direction and continues. But this is the second state of transition, trend becoming range. And then the third state of transition is trend becoming opposite trend. And this is a complex reversal. It's a two-stage reversal. The first stage is here on this three-bar pattern that puts in the low of the reversal, and this is a bearish bar, a pause bar, and then a bullish bar that is pretty much the same. It's quite symmetrical. And then this is a higher low, which is a signal that a potential bottom is in, a reversal is happening. If you get now a strong upside trend bar, trend price action, as you did on this follow through bar, then there could be a good entry in here somewhere for an upside reversal type trade. You have to be patient on this one and hold your stop below the signal bar, which is this low down here, in order for that trade to work out. Because unless you're scalping, if you're scalping, you could take profits on this first push. But if you're swing trading, you have to wait and hold through this micro double bottom pullback before you get some good continuation to the upside. So ranges are characterized by sideways price action. You can get congested ranges like this, and you can get ranges where price swings back and forth. I'm not sure I'll be able to find one of those on short notice. This is probably a fairly good example where we're kind of looking at a range here where price is swinging to the top, swings to the bottom, can't decide here in the middle, and then swings to the top, swings to the bottom, to the top, to the bottom. So congested ranges, ranges that have swings. And then within trends, you identify trends using either pivots or higher highs and higher lows, or trend lines and trend channel lines. And then there are also reversals, which are typically classified by either a 1-bar reversal. This would be a good example of a 1-bar reversal bar. The context is not good for a major trend reversal. This is a good example of a 3-bar reversal pattern where you have a down bar, a pause bar, and an up bar. And this is a fairly good example of a 2-bar reversal pattern where you get a strong down bar and then a strong up bar. In this case, you could call this an outside bar, you could call it an engulfing bar. These are good reasons to take reversal trades, these 3 patterns here: 1-bar, 2-bar, and 3-bar reversals. We also talked about breakouts from ranges into trends. That's a changing condition. We talked about pullbacks and also trends ending in ranges, so price action going from trend to range. And then we talked about trends turning into opposite trends, which is reversals. Yeah, thanks for watching. I hope you learned something. I hope it'll help improve your trading.